those of you who don't know me, I am John Ellison. I'm the head of programming, I guess, for the past, doesn't feel like 2 years, but I guess it's been about 2 years. I run a firm here in town called RQA. We're the quants, or we like to think of ourselves as the quants here in town. But after a lot of deliberation about the format for tonight, we decided to change it up. We've always had somebody behind a podium, death by PowerPoint, and we decided, let's do a fireside chat format. I agree. And I think that you will all be, you won't be disappointed. We have two highly esteemed individuals up here. So I'll introduce them, and then we'll hand it over for, I guess, sort of an overview of what we're going to talk about tonight, key topics. I mean, there's not a lot to talk about these days. Markets are kind of calm. Geopolitics is fairly, placid water. But I think we have some individuals here that can cover the topics from a wide range and go fairly deep. So first and foremost, we have Simona Mocuta. Simona is with State Street, a little boutique up in Boston. She is the chief economist for State Street. She's been in that role for almost a decade now. She also leads the policy and politics team at State Street, where they assist with a lot of the qualitative inputs on the multi-asset strategy. To her left, we have Andrea DiCenso. Andrea is a portfolio manager. We wanted to marry up an economist with a portfolio manager to kind of get a holistic view around the topics. And she's a senior strategist with Loomis Sayles, another teensy-weensy firm based up in Boston. Andrea is in the multi-asset credit group and handles emerging market debt in the total return strategy. She also is a senior strategist in the Alpha Strategies group and oversees all Forex and commodity activity for the firm's trading. So kind of a lot of everything. They both have a breadth of experience with everything that's going on these days. I think we couldn't ask for better guests to take a dive into each of these topics. I'm going to hand it over to Simona to get us kicked off on what we're going to talk about tonight.
Well, maybe I'll just start. First of all, thank you for the invitation. It's wonderful to be here. It's my first time in Richmond, and I was telling my colleague, people here are very friendly and happy. I mean, like, genuinely, the moment I step off the plane, somebody's like, welcome to Richmond. I'm like, I know I'm not in New York. And it's kind of continued like that throughout my stay here. So I definitely look forward to come back. Hopefully this evening goes well enough that you'll invite me back. But let me just set the stage a little bit. And again, I'm an economist, obviously working for a huge asset manager. I don't manage money myself. I am surrounded by investment teams everywhere. I sit on the trading floor. And, clearly all of these are super smart people who have been in the markets for decades in some cases, so you always wonder, like, okay, what do you bring to the table that's a little bit different, right? And I think what our team, it's a small but highly visible team of economists, is, as I tell my own team, like, our job is not to come up with the view of the week or the view of the month. Your job is to help the investment teams anchor their thinking. So, you want to highlight to them the things that may not necessarily be in the headline today, but they will become the headline, and the things that will have a lasting influence on their investment decisions. At the end of the day, they own the investment decisions, but you help them come to their conclusions, right? So more than ever, I think there is value there, like, to not overreact. I'm an economist, I love the data, but sometimes, like, as the data comes through, I want to stand up on the trading floor and say, ignore it, right? It's not always the initial knee-jerk reaction that holds the truth. But especially now when so much is changing, right? So, like, everybody looks at it and it's like, okay, so what's going to happen with this? What's going to happen with that? And frankly, I don't have the answers, right? Because truly, who in this room or anywhere in the country can tell for a fact this is how the tariffs at the end of the day will play out? You make a lot of assumptions. You have reasons for your assumptions. So I say, okay, in this world, what should we do? Now, how should you even deal with situations like this, whether it's today and the challenges of today, but any situation in general? How do you think through situations like this? And I always say, okay, there are things we don't know, right? And there are things we do know, right? I like to talk nowadays about the known unknowns. You kind of know where your risks are, what the changes are coming from, whether I put them nowadays in 3 buckets, right? Like one is trade policy, one is immigration policy, one is fiscal policy. So my 3 known unknowns are tariffs, trade and immigration. So what I do know is, number one, the US is actually a fairly closed economy. When you compare around the world, imports as a share of US GDP, it's about 14%. That's relatively low. If you're looking at some European economies, you get into the 40s and 50s. So it's not that trade doesn't matter, but it matters. Put that impact into that context. So one takeaway, regardless of what happens, whether it's 10% or 50%, the share of GDP gives you an anchor of, how concerned should I be? The other thing on trade that I remind our team is like a lot has already changed, right? If you look back to 10 years ago, China was by far dominating US imports. That picture has changed. I'm not sure how many of you are aware in this room. We import more from Mexico today than we import from China. And actually, we import as much from Canada as we import from China. So, last Friday was stressful because you're like, the tariffs that hurt are actually the tariffs on China and Mexico more so than, on Canada and Mexico more so than China. So I'm glad to see those delayed. So anchoring on those realities, which are facts, that's what the numbers are. So then you can, help assess the ultimate impact. Similarly on immigration, I would say, what do I know? Again, I hear a lot of words, the same ones that everybody in this room hears, but what number are they associated with? I don't know, right? But I do know that the labor market is fair, at least in my estimation, and we are happy to have, nobody holds the absolute truth. Hopefully this will be a conversation and we invite questions from the audience. But the labor market today is more or less in balance, at least in my estimation. If I'm looking at things, nobody seems to be quitting. Well, people are quitting now, but for a different reason. So let's put that to the side. But if you look at the quits rate, right, nobody truly has the vibe of the labor market better than the people who are in the labor market and seeing it firsthand. If you look at average weekly hours, those are now as low as typically you've seen in the past only in recession. So something no longer adds up to this narrative of the labor market super tight. Wage inflation has come down substantially. So I think, regardless of the numbers that end up happening on deportations, the impact will be less inflationary than if you had this policy, say, a year or two ago when the, excess labor demand was much more sizable. So, you can go on, but this is how I think through these things. And, at the end of the day, you have to put out a forecast. You have to have what's your view on X, Y, Z. I will tell you, I'll summarize it by saying it's still a soft landing. And I say still because, frankly, that's been our story now for a very long time. Even, when inflation was 9% and people were like, there's no way you can get this down without a recession. We're like, well, maybe you can because of, how unusual this business cycle is. So that's still the story. I still think despite, but it's a soft landing with two-sided risks. I think you have to acknowledge that, last year the risks were, in my estimation, more to the downside. It was a question of, yes, you get this disinflation. It was a high conviction view in a way last year. Disinflation gets you to rate cuts. It was more, if you had questions, it was around the timing. Now you have questions about the direction as well. So for everything that, opens up upside risk, which you have to say this is a, pro-growth agenda, deregulation agenda, everything on energy, we want it, right? So those are upside risks, but you also can do the same things poorly, and you open downside risk. So like even a recession, you cannot completely discard it. Why? And it's ironic because typically you say, well, the risk to the upside come from here and the risk to the downside come from here. Today, I would say they come from one and the same place, which is your own policies, right? Like how you do it, how aggressive you go with some of these things can turn something that could be positive into a negative policy impact. So all this said, we still think there is a little more to go on this inflation. We have 3 Fed cuts this year, which I know it's more dovish. We were dovish last year and it worked out. But I can no longer today sit in front of you or even my own colleagues and say it's a high conviction view because the risks are much more substantial and directional this time than a year ago. So maybe I'll stop there for now and we can go around the world, but that's my opening.
So we're debating a lot of the same topics at Loomis Sayles, and you're tying the thought process behind tying tariffs, tying immigration and overall employment directionally to inflation is something that we think about, but we're also thinking about how does that tie to growth and the delta of growth of what's being priced into markets today, because that is really what ends up having those ripple effects on how consumers spend, on how individuals spend, on how global economies are impacted from asset flows, whether they're moving into more defensive assets or more risky assets like, those high flyers across equities. So when we think about immigration policy and we think about what impact could that have on job momentum or job movement? Right now, it wasn't that long ago when there were basically 2 open jobs for every 1 person in the US. That has collapsed. We're now at about that 1-to-1 ratio. So, employment being a different picture this year than it's been in previous years is very much a top theme. But we also have to think about how comfortable are people about their job stability? How comfortable are they in their ability to find a new job should they be laid off? That has significantly decreased. And that has implications on how they're spending. And we're already beginning to see that, not with the higher FICO score borrowers, but really the average everyday person who's spending, who has on average right now about $300 in their savings account. That has fallen dramatically from COVID levels. And credit card balances, you're looking back at these balances now rising to crisis levels. So the longer that rates are staying higher and the Fed has to be thinking about that push-pull of inflation coming back to the forefront, the higher those mortgage rates are going to stay, the higher those credit card statement APRs are going to be, and the more struggle you're going to find with those lower FICO score borrowers. But how we think about this in growth is the consumer drives about 2/3 of the economy. It's not those lower FICO score borrowers who are driving that. It's really that top 40% of the FICO score that drives that growth. So it's not until that cohort gets materially impacted, concerned about prices. Maybe it's the fact that they can't find eggs in the grocery store. Maybe it's their overall energy bill is on the rise. That is likely to be the shoe to drop that we're watching to see a change in spending pattern in those upper FICO score borrowers. When it comes to tariffs, this is just,
it's a whirlwind. Let's use a nice word.
It's
a whirlwind.
To say last week, Friday, and the beginning of this week was ridiculous is an understatement. But this is the world that we're living in now. We're living with pretty much tape bomb after tape bomb coming from the Oval Office. And Trump 1.0 was just, sort of appetizer for what Trump 2.0 is beginning to look like. And the reality of the situation there is also, again, thinking about how do tariffs not just impact U.S. growth, but impact global growth. Yes, we are very lucky that we've diversified who we buy from, but China still manufactures about 30% of global manufacturing. So what China does in response to whatever is coming down the pipeline with the Oval Office and with Washington is going to be extremely important, not just to US growth, but to Europe, to pretty much any emerging economy at this point. So like it or not, we are all going to live minute to minute and just take that volatility and find the opportunities. So now what Simona was saying is, she's sitting on a trading desk saying, guys and girls, ignore the headlines, focus on the relative value, focus on what's priced in. And that's what we spend the majority of our time doing, saying what asset class is appropriately pricing this risk at this point. I think what concerns me is when you look at, high yield spreads at this moment in time, not really pricing much probability of an increased risk premium, of an increased term premium. But you are beginning to see some pockets of opportunity. You saw the dollar react very aggressively to this US exceptionalism trade. You saw emerging market FX basically be the whipping boy for that tariff headline filtering throughout markets over the last 45 days. So there are those opportunities to say there is a relative value mispricing here. How can we be tactical with our portfolio allocation? Because tactical is probably your number one asset right now as an investor, is to say, I'm going to have to be nimble and change my asset allocation, change my quality skew, or just your overall asset skew within your portfolios.
So I hear this a lot, whether it's soft landing, hard landing, no landing. I hear it from a lot of people that probably don't even know what they are talking about. It sounds to me like there's a lot of binomial outcomes that can come from, from the government. In your mind, are tariffs and trade policy the biggest threat to causing further spikes in inflation and then that dragging us into a recessionary landing scenario?
So I'll say short term, I do worry about tariffs because you've had the experience in the past where, even in 2018, we didn't do this sort of broad across the board tariffs that we are talking about right now. You did have an initial hit to inflation. It tends to be temporary, and then I actually did I tried to pick some examples of what happened in the past. You have the short-term effect, which is inflationary, and then longer-term things stabilize. How many of you remember we did tariffs on washing machines in 2018? So you did have the impact. I remember the headlines. It's not just the washing machine prices went up, but dryers too, because why not, right? It's opportunity, for once in a lifetime opportunity. Let's jump in. But then if you went back 2 years later and ask yourself what happened to prices, actually prices corrected, and I'm not talking about the inflation, which just simply, tariffs falling off the calculation. Price level actually went almost all the way back to what it was pre-COVID, pre-tariffs, but you did have Samsung and LG, both of them increased domestic production. Now, you can do that in one commodity, one at a time, not, across the board. So I do worry about that. Right now, looking, what are other sources of near-term inflation? I do agree with Chair Powell that if you look at the labor market, it doesn't seem to be it. Again, I think absolutely if you get to the point where it's you have scale on deportations, you could start to build a new story where you are impacting negatively the labor supply, and perhaps that gives you the wage inflationary pressures reviving. But I think that's not a next 3 to 6 month story. It's a little bit longer story. And again, what are the numbers, right? You have huge inflows over the last few years. This is a labor force of 160 plus million people, right? If you let's say you get to 1 million, which is a lot of people, right? Given historically, you did deportations under President Obama, for instance, about 400,000 plus for a few years. So, when you say the biggest exercise we've seen, like 500,000 would actually qualify, that doesn't dramatically shift the dynamic in the labor market. So I don't want to be, dismissive of this as a pressure, but I think first and foremost, I do worry about tariffs from purely an inflation standpoint. Maybe one point to say, because you brought up a good point. We throw these terms around, soft landing, hard landing, but then everybody has their own understanding of what that actually is. So maybe I'll give you my non-scientific definition here. So in my mind, at the end of the day, it's all about the labor market, right? Like slow hiring, it's soft landing in my mind. When slow hiring turns to firing, that's when you're talking recession, right? Because nothing changes the spending pattern more dramatically and immediately than you losing your, major source of income, which is your job. So that's the one indicator that to me, like I'm watching most carefully, like how do those scales tip in the labor market? Right now it's great, frankly. If the Fed had a magic wand and said, we can freeze things somewhere, now is a good time to freeze things because inflation's a little high, but the labor market is great. Everybody has a job pretty much that wants it. Wage inflation is okay. Unemployment's low. It's right there with the neutral rate. So, what's not to like? The question is, can you keep it here, right?
I mean, to answer your first question, yes, tariffs in our mind are the number one concern when we think about inflation kind of boiling higher. However, it's, you think about waiting for published economic data before acting. That's not how asset prices work. They react much faster. And it just makes me think of the kind of the statement that perception is everything. And this is why this backdrop is so challenging to invest in right now, because we are basically drinking from a fire hose of news coming from Washington around what trade policy looks like, what tariff policy looks like. I think a couple weekends ago, Colombia had tariffs on it for 9 minutes in total. Yes. I mean, it's how do you, our sovereign analysts published a note and rescinded it all within 2 hours. So it's almost like you want to just light your hair on fire reading these headlines. But the perception is that the chaos is going to continue. It's not going to stop, whether it's a negotiating tactic like we saw with Mexico, with Canada, or it's a more persistent, targeted, unknown, like what we're likely to see with China. And then I think you have Europe just sitting in the middle here saying,
awaiting,
please look somewhere else. Yeah. And this is all going to give the perception that inflation could see these bumps higher. And that could make the Fed have to do something about it. Yeah. And that is what worries us, because that published economic data, if the Fed continues to telegraph that they're going to be in wait and see and wait to see the data, they might get into a stagflationary environment. And that is not a great backdrop. It's something that could push us again, as Simona was saying, out to those tails. Those tails are getting fatter and fatter because are we in higher for longer, or are we worried about a downturn? Yeah. And the Goldilocks scenario evaporates.
I worry that we'll be back to where we were last summer, right? So just to recap a little bit, we were of the view that the Fed should have started cutting rates last summer. We were very confident on this inflation, but there was the Fed. We need to wait for the data, right? And then, the summer went and you're like, well, look at the unemployment rate, you really should have started. And then they started with the 50. In the end, you kind of end up in the same place. But there was when I had the highest degree of anxiety last year was after the June meeting. I was like, how are you people only predicting one cut? It's not enough. You need more. How long are you going to wait? And I worry about being in the same situation. Now you may be it could be even more ironic, because I think over the next couple of months, you're going to have improvement in core PCE, and the Fed is going to be like, but it's happening now, but what if we lose it, because of tariffs? So it's a very frustrating situation. And one thing you said, this idea of, lots of, responsive, even in a best case scenario, like where things don't happen the way you might fear, that doesn't mean that it's a smooth ride. It's going to be hellish. It's stressful because you're always going to look for what's around the corner, like what announcement comes next and how do you interpret it. So it's going to be, it's already just February, but it's like, have we not aged already? So it's going to be intense.
So I should have mentioned this at the very beginning. If there are any questions throughout this discussion from everybody in the audience, please feel free, raise your hand. We have microphones that can, come find you.
Or you can yell.
Yeah, or yell. I actually have a question to kind of take us further into the discussion. So it sounds like market volatility, we don't know what's coming in the next 30 minutes. It sounds like, and tell me if I'm wrong, growth remains relatively stable. Everything is sort of in a generally okay environment on the growth side. Inflation is moderating. The tails are there for sure. But I view, the global markets as basically a big flow chart. And it seems to me that the general theme for, government policy, what the markets seem to be trading on is strong US dollar, American exceptionalism. As we look into 2025 and we look at the asset class mix, is the US still the cleanest dirty shirt in the pile? Or are there other opportunities that, we just really haven't thought about?
I think the first few weeks of the year kind of highlights like maybe that trade was a little too crowded. And I mean, all trades mean revert in some respect, but when you look at equity performance in European equities, up almost 10% year to date, US equities, 2 and change. So there's something going on underneath the hood there that questions, are people, your next marginal dollar, are you going to put it to work in a country where you do have so much confusion around what is the next headline you're going to hear? Or are you going to put it to work in a country where you have, the knowledge of ECB is on a cutting cycle. They are vocally dovish. We understand the forward path of rates there. That does give you some comfort. When you take it to the fixed income markets, you're seeing, yes, a general appetite for risk-taking, high yield performing quite well in US markets, but global high yield is far outpacing US high yield markets. So that does have us thinking about, as people are investing, they are more willing right now to say, I'm going to take this money and put it to work in other countries, diversify my regional exposure, perhaps more of my industry exposure, so you don't get moments like we woke up a few Mondays ago with DeepSeek hitting your headlines and just really destroying some of your portfolio returns.
So again, let me comment on this more as an economist, right? Because I think implicitly in every client conversation over the last year, and I travel around the world and I talk to clients pretty much around the world, in one way or another, that was the question, like when is it time to pivot away from the US? And they ask me, even though I don't manage money, right? But like your opinion. I would say from a macro and growth standpoint, if I were to summarize, the Trump administration message is not yet. That being said, and I would say, implicit message to the rest of the world is help yourselves, right? Because it's not just about what the US, you made a very good point. It's not just what the US does, but what the rest of the world does, whether it's China or Europe or others. In a perverse way, you almost, I'm glad to see that there is some pushback as a reminder that it's not just, you do whatever you want with no repercussions whatsoever. But I do worry about Europe from a growth standpoint. I mean, one of the most depressing charts I don't have charts here because it's a fireside chat, but one of the most depressing charts in my whole global macro deck is German industrial production. I mean, it's hard, it's sad to see. It's basically this continuous ongoing erosion. And you see that and you're like, okay, how is this going to turn around, right? So I think it's one thing to say you're moving money elsewhere because it's a better story, or it's just a rotation and like diversification. I understand the diversification, I understand the valuation, but frankly, like what I want out of Europe is like bold policy. Around the world, you can go and say pretty much to every country, you've spent too much money since, during, and the last few years. Too much fiscal expansion. The one exception to that is Germany. We're like, can you please spend? You have plenty of money and you do need to spend. Will you please? But they have this like debt rule that's very self-confining. So you do wonder, like, last year, remember, everybody was like, oh, the year of elections. Well, for Europe, I think 2025 is the year that matters. You have elections in Germany. Does a new policy direction arise from there that moves the needle here? I would love to see that, and it's actually good for the US, not just like, okay, to have another market to invest as investors, but frankly, you want your allies to be strong, right? And Europe right now is not strong. And the vulnerabilities are there, whether it's on defense, whether it's on energy, pretty much across the board. And you're like, okay, how do you turn this around? It's not enough to tell a story that Europe is doing better than it did last year, which, we have that in the forecast. The ECB helps, but frankly, the ECB can't fix that problem. Europe has homework. It's called the Draghi report. Now, question is, do you do it? Do you do your homework?
So, in terms of, I feel like most folks in the room, or most clients of the folks in the room, the focus is equities and bonds. The base camp of 60-40 portfolio. Is the tried and true 60-40 that everybody has grown to love over the past 3 decades still a great place to be? Or has that theme changed, and why?
I don't think the theme is dead. The 60-40 is still here. Those allocations, we can debate that, and not sounding self-serving, maybe I'd put a little more into fixed than I would into equities at this point, but I think that's also just indicative of my concern around the growth implications of tariffs, of these tit-for-tat, trade war talks. And I don't think those are going to go away. And inevitably, when I think about the future path of Fed funds in the US, it's most likely to be lower. And then, the next question is, where does term premium go from here? That's really a question around what does President Trump do? I think that is kind of a toss-up at this point. You could see spikes of term premium, and then you see this flooding of people getting concerned and jumping back into duration-sensitive assets. And that's why I feel that when you think about what asset class has repriced, has an attractive, overall risk premium available to it, and some potential to not only earn that carry, but also see some price appreciation, you're going to find that more consistently in fixed income markets at a much lower volatility. For the first time in a long time, Treasury risk premium looks as attractive, if not more attractive, than equity risk premium. And that is when investors should start to think about how much is in equity versus fixed in that 60-40. Also, the inclusion of private debt, private credit, that probably plays some role within that 60-40 that should likely take from the equity allocation. And private credit is not going away. It is here to stay, and it is only likely growing from here. So to be able to have some portion in your portfolio that has that more stable yield and is less likely to see that price movement and gyrations from these headlines is going to be something that is going to be additive to investors, not only this year, but through the entire, I was going to say Trump presidency, but we don't know how long that will be. It could be more than 4 years.
Don't. I think what's interesting, like everything. So I would venture to say that our house view is aligned with what you just said about seeing value in fixed income, despite the risk, despite the concern about the budgetary picture, which is terrible. I mean, let's be honest. Another striking chart in the macro deck is the U.S. interest payments as a share of like federal revenues. It's 20.4% last time I looked the other day. I mean, just think about this for a second. Like if you're an individual and went to work Monday through Friday, all of your Monday goes to not pay down your debt, but to pay interest on your debt. I mean, that's not good, okay? This is the context in which we are talking about, further tax cuts. I don't think we should be talking about further tax cuts. I understand extending parts of, what was expiring, but this is, maybe not today's problem, but it is a problem over the medium term. So I think that's the dilemma that most people, when you assess how attractive is fixed income, is like, but how do I think about this? Because this picture has changed dramatically. Again, nobody, like 2 years ago in those client conversations, nobody ever brought up US debt. Over the last year, regardless where in the world you are, this is part of the conversation. So like, what are you guys thinking? How should we think about this? How sustainable is this? And like, I will say, like with everything else, it's a relative game. I'm not particularly worried, like, imminent challenges here. You are the world's reserve currency. I think, other people, the smaller players get punished before you, and you saw that in the UK. Worst case scenario, I mean, like at some, the Fed also will end QT, probably around, middle of the year. So at least one of your like sellers is no longer a seller, right? Even if your supply increases from someplace else. So, but it's certainly something to watch and try to understand, how do you think about this? Long term, as an economist, like I think there is a genuine debate as to long term, is this debt inflationary or disinflationary? Because, so many resources are gone towards like, servicing your debt. They are not going someplace else. That's a growth activity, right? And how much is sustainable? Like at some point you start thinking like, we forget that we were in a zero interest rate world for so long and there was so much financial repression. But between default and return to financial repression, I think you'll take financial repression as option one, right? So that's why I think it's so, you can still make a case both ways, right? Like yields can go higher, rates can go higher, but like for a while before they have to come back down, or else you cannot, sustain this. So it's very ironic in a way that, but I agree with you. I think we see value. Like I think that, again, we are of the view that the neutral rate has gone up, but not dramatically, right? So even when I talk about those 3 cuts that the Fed can do, is with an eye with like, okay, how far away from neutral am I? And even if I cut 3 times, do I still have a little margin of error? And I think you still do. It's tariffs that can mess this up, but otherwise you should be able to get there. And, who knows what we get on tariffs at the end of the day. Oddly enough, China was only 10%. I'm like, really? Like if you're going to do tariffs, like you think you target that more than Canada. But,
So,
I think questions are arising now.
Thomas.
Yeah, I'm just gonna jump in front of Thomas here real quick.
Of course.
Okay, so you've highlighted a lot of these concerns, and right, they're all in all of our minds. So the estimate for S&P earnings for 2025 is plus 13%. Will that stand? And before you answer, I just want to mention you guys, Jason Trennert, who was named basically Deputy Treasury Secretary today, sat in your seats just a few years ago. So if you do a good job tonight, you could be a political appointee.
Promotion. I defer to you on the equity front.
Well, I to be fair, I think it's so let's think like walk almost backwards, right? If you have real GDP growing like we have 2.2%, let's say ballpark 2, right? You have inflation on top of that, another, say 2.5. How much can you add to that as profitability? I think like it's getting to double digits. I don't know if it's 13%, but getting to double digits, I think, is doable. I think it's doable. I think, what's interesting is, speaking of the high interest rates, like you look at households, actually households are net creditors. Right? If you look, yes, debt service costs have gone up, but interest income has gone up even more. So like households on net are actually are benefiting from high interest rates. Interest rates are so high, yet net interest expense for non-financial corporation is super low, right? So like actually you're not, your profit margin is not hurting because of that. The one part of the economy that's hurting from high rates is the government, because they did not term out the debt when rates were super low. You're like, well, should we have done that? But now it's too late, I suppose. I think it's doable as long as you maintain a soft landing scenario that, doesn't, do you do significant tariffs? That 13% is not going to be evenly distributed. Not everybody is going to be, able to dodge it. On tariffs, I think the magnitude also matter, by the way. One of our colleagues in global markets, they did a paper recently. If tariffs are generally sub 20%, they tend to be broadly absorbed along the supply chain. So a little bit here, a little bit there, it actually by the time it hits the consumer price index is really like a very diluted effect. So not everything, from here translates there. And in the same way, I think a lot of these things can be offset by productivity, wage unit labor costs are growing, roughly 3%. 2.5%, so pretty much in line with inflation. They're not eating into your margin. So, I think it's doable, but, I also hear people like, oh, that's too optimistic. It's never happened. Like, well, but also, it's also hardly ever happened that we brought inflation down from 9 to 3 without a recession. So, let's be open-minded. That just because it didn't happen in the past, or it seems difficult, it doesn't mean it's impossible.
Thomas?
Thank you, James. As you mentioned, I would remind you that the majority of the Treasury securities are held by Americans, and so that is direct income to them as per the high FICO scores. Spending a lot of money, they're getting 5% returns on their cash. Uh-huh. So they're doing well. The question I have is, what do you think will happen to the U.S. dollar? What effect will these trade tariffs and uncertainty, what effect will those have on international currencies?
So I think we can just take, basically maybe the few weeks before President Trump was nominated or voted into office, through his inauguration, and then through the few weeks of nonstop tape bombs from him about tariffs. As any indication, we saw the dollar move from 101 to 110 on the DXY. That is exactly what tariffs can do to the dollar. Now, is it have to stop at 110? No, it definitely doesn't. But all we had was a one-sided story at that point. We had one person talking about, he is the tariff man, it's his favorite word, it's going to be here and not ever leave. Now we're beginning to hear in the last few weeks, just Actually, it hasn't even been a few weeks. It's
No,
been
it
a
just
week.
feels like a few
Yeah.
weeks, but it's been 3 days.
Yes, it's been a week. And what we have heard is Canadians are angry, very angry, which is
It's not good.
the first time ever.
It's understandable.
We've heard Europeans are not happy with the US and they will boycott different US products if they feel that they're overpenalized in any respect. And China's being very targeted with their tariffs. And the subsequent action you've seen to the US is the questioning of that US exceptionalism trade. And the dollar has moved from essentially 110 back to 107. So this is the effect you're going to have. You get this mean reversion. Now, the dollar has been in a bull trend for over 10 years, and bull markets in the dollar historically last anywhere from 5 to 7 years. So we're already long in the tooth in this trade. It is ripe for some sort of price action in two-way trading instead of everyone just piling in nonstop. Now, the other reasons that we could see the dollar roll over as more and more retaliatory tariffs come back towards the US is just, again, that general commentary coming from Treasury Secretary Bessent and Donald Trump himself is that they want a weaker dollar to spur growth. So they are going to try to manufacture that as they are dealing with these tariff headlines. So our bias is to say you're going to have fits and starts of the dollar spiking higher, but there's going to be a clearing level where traders, algorithmic traders, are willing to say this has gone too far and it's unlikely to stay up above 110 for a sustained period of time. You have to then also think about that's only short term. Medium term, that's more interest rate differentials. Now, who knows what the Fed is going to do? 3 cuts, 2 cuts, 1 cut, hike. I don't know what's coming. I mean, the repricing of the expectations around Fed cuts and hikes have been more frequent and more volatile in the past few years than what we've seen in the past decade. And that's likely to stay with us. Now, what we see from most other central banks outside of Japan is their willingness to cut when they get concerned about growth. So that could be a headwind for dollar weakness, and that's why we think this volatility is here. But in our opinion, the long-term directionality is going to be lower because President Trump and Bessent will manufacture that narrative to see it come lower.
So I would say the way I, reinterpret what I hear is I don't think President Trump wants a weak dollar. He wants the benefits of the weak dollar, but a strong dollar. So it's actually a contradiction in, trying to, pretty much every policy you put out there is a strong dollar policy, but you actually don't, you also want your exports to do well. Well, the more expensive the dollar, the harder it is for, foreigners to buy your product. So it's a contradiction there. It's something that you watch to see how it plays out. But I think they would love the strong dollar because it helps you with inflation. Everything is affordable for Americans, except, your trade deficit is going to actually increase. So, how do you prioritize your conflicting priorities? I'll have to say, I think that these expectations, and I talked to our exchange, currency team as well, the story of, the dollar cycle is long in the tooth. It's been a very frustrating, prediction to make because I think that, even 2 years ago, there was probably the most consensus view that the dollar has to weaken and, well, guess what? Not this year, right? So that can continue as well because, yes, retaliation will hurt the US, but again, Europe has a much higher exposure to trade than the US. So the relative hit is always going to be more on those other economies than on the US. So it's maybe the 10% appreciation was overdone, but you're not going back to all the way, right? You need something else to say, okay, the other economy is going back to the story. It's has the story outside of the US genuinely improved? And, the most you can say is it's improving relative to their own kind of uninspiring performance, is it enough, right? So, I'll just say that like we want to say that like it should depreciate, but at the my colleagues often talk about this, the dollar smile, and I think you can think in the same terms about even fixed income. You can love fixed income in a soft landing, inflation's coming down, the Fed's cutting rates is great for fixed income. Recession is also better for fixed income than equities, right? So like you can like that asset class in two very, very different scenarios, and the same with the dollar, right? The rest of the world does better, growth improves overseas. It's a dollar weakness story. Like everything else, whether it's US strength in demand or some kind of risk-off sentiment where like you're trying to get liquidity, it's dollar strength. So like the same outcome can come from two very, very different scenarios, like how did you end up here? I think you are waiting for that dollar softness, but like show me a compelling story someplace else. And it's hard to find.
Thank you. My name is Matt Buxton. I work at Loomis Sayles, so I swear this is not a planted question. I think one of the things when we think about long-term economic issues is demographics. And the demographics for almost every country in the world are terrible. For certain countries, Russia, I saw a presentation where someone said, if Russia was Catholic, we'd give it their last rites. So I think when we talk about long-term economic issues and when we talk about where countries are going to grow, demographics become a much bigger issue when you think about the baby boomers aging, let's just be honest, unfortunately passing away, and that large generation sort of disappears. How do demographics fit into how you all think about long-term investment prospects for countries, regions, sectors? I'd love to hear what you're thinking about that right now.
Do you want to start?
Sure. I'll take this and kind of apply it to a subsect of what I focus on, and that's within emerging markets. I'm going to skip over the last rights for Russia. But when you think about what area of emerging market debt, even emerging market equity, that is really attracting a lot of attention right now, it's the frontier space. And that is where the demographic story is completely flipped on its head from what you were just describing. It is an environment where the youth population is coming up. It's better educated. You're seeing a lot more productivity in those younger generations. And it's a backdrop also pushed further ahead on it through tailwinds coming from basically a restructuring cycle that's flowing through this space. So you're seeing multilaterals like the IMF, like the World Bank, funding, just overall build-outs of these countries. So this story playing out through sub-Saharan Africa, playing out through Latin America, playing out through Asia is really a unique opportunity at this moment in time, something that we haven't seen in over multiple decades happening within emerging markets. It's created a bifurcation where most individuals are thinking emerging market debt, it's the highest risk, it's the lowest rated, it comes with a lot of volatility. We are seeing these countries, this country, this portion of the debt acting relatively stable in this backdrop where DM markets, where UK markets are acting more and more volatile, more like what individuals think of emerging market debt to act like. So in that diversification theme, think about the regions, think about the areas that are being driven by younger demographics, that are being driven by restructuring trends underway. Many of these countries recently have come out of their default cycles. They tend to be serial defaulters. However, the first few 3 to 5 years coming out of a default cycle, you're looking at high double-digit returns in that space. So having analysts at your disposal to do those deep dives, to be able to identify those demographic shifts, those restructuring trends, is going to be additive to your overall portfolio allocations. But you need to be mindful of their debt load, because at the end of the day, They tend to use their currency as the release valve, and you can easily get caught in a debt cycle there. So it's important that you're monitoring exactly how far they are in that restructuring cycle.
So as an economist, I do think about demographics a lot because at the end of the day, there are only two factors of production. One is called labor, the other is capital, right? So you kind of have to look at what happens to the trend in these things. Our focus on demographics is very closely tied to our views on what the neutral rate is, right? So that's part of the story as to why we don't think it has risen quite as much as some people say, because you look at the demographics and like things are not getting any better over here, right? Like they look much better in other countries, but even in the fast-growing population, the population growth rate is actually slowing, and in some cases dramatically. It's one of the reasons why when you look at China and like I tell my colleagues, I'm like, you should no longer think of China as a 5% economy. Their demographics is worse than the U.S. If you fast forward 15 years, the speed of deterioration in China is actually worse than in the U.S. It's also why I can understand, deportations today and a policy that tries to reinstate order into the system. But I want this country to actually have a genuine immigration reform. I'm an immigrant. I came here as a student. I went through my H-1Bs processes. I'll just tell you an anecdote. So recently, I had a procedure that required anesthesia, and I say this because the lady who greeted me when I went there was from the UK. The guy who put the IV was from Italy. The doctor was from Thailand. The anesthesiologist was a white American guy, and the nurse at the end was from El Salvador, and the patient was from Romania. Okay, so it's like for anybody who anywhere in this country thinks the U.S. can do as well as it has done without immigration, you are deluded. I'm sorry to say, that was not what I was asking for, but that's the reality. I'm all for, let's have a system. I wish we could learn from Canada and Australia, which have, a skills-based program. I actually think 55,000 or 65,000 H-1Bs are not enough, for what this country needs. I'm all for having order, but so that matters, because your demographics, that's one advantage the U.S. has. I'll tell you another story. At my previous job, I used to run a team looking at Asian economics, and at one point I was I had a guy who was a UK citizen living in Beijing, speaking Chinese, and he got accepted into Stanford. So now I'm looking for a replacement for him, right? So you put out your resume, and I get flooded by resumes of Chinese girls studying economics at Boston University and all over, over town, to the point where I called my former advisor, is there anybody else other than Chinese girls studying economics in Boston nowadays? Let me tell you, not a single person, not a single one of them, they all wanted the job. Not a single one of them wanted to go to work in Beijing. They said, send us anywhere, I will go to any of your global offices. We don't want to go work in China. You know who I hired? A guy from Alaska who spoke Chinese, who wanted to improve his language, who went to Beijing. Married a Chinese woman, he's back to the US now. But it just goes to tell you, to me, when people ask me something, if you only have one choice, which country would you put your money in? And the reason I say US is because this story. You cannot lose this, right? You can do it you can improve how you do it, and certainly the system, especially today, needs improvement. But let's not forget the benefits that you get from immigration, and that can be sort of the gift that keeps on giving, because if you read some of the statistics, so the U.S. has this green card lottery program, right? Which, crazily enough, a cousin of mine won, and he didn't want to use it. And I was like, are you crazy? And meanwhile, I'm trying go through the whole system here to get a green card. But But I think you have, like, I forget what the number is, 50,000 a year or something. And I think like 14 million people apply around the world, some crazy number like that, right? So like that is, let's not lose that, right? Let's make this still the place where people want to go.
Yeah, from a geopolitical perspective, what's your outlook on China? Like, what do you think their intentions are with the DeepSeek announcement, Taiwan, etc.?
I heard China and Taiwan, but not the actual question. Can you repeat?
Yeah, Chris, can you say it one more time?
Oh, yeah, absolutely. Sorry, like with China announcing the DeepSeek last Monday, and then possibly what they might want to do with Taiwan may or may not happen, but any thoughts on that at all?
The China-Taiwan story, I think it's very interesting, China's planning and timelines overall. Like in the US, I don't know if we're just kind of conditioned to think in 4-year increments because we think in presidential terms, or that's the mandate that we have for the next 4 years, so how do we get through that? In China, they're thinking in decade-long terms, and that is a difference in thinking that makes it very hard as a U.S. investor to kind of overlay a strategy to that. Now, when it comes to volatility associated with an elevated state from the current state between China and Taiwan, in our opinion, and our China sovereign analyst puts a very low probability that in the next 5 years we see anything materially move to a more elevated state than what we are at right now. Now, that doesn't put that at a 0 probability, it's just a low probability. The factors at play that we would be looking for to say that this is a growing probability increasing is more rhetoric coming out of their own internal meetings. Now, we have analysts, sort of boots on the ground, who are scouring through news sources, and they see no uptick in rhetoric on that front. So we would expect to see more confusion, more consternation coming from local news sources there before we would start to put a higher risk premium on potential implications and tail events from that. I do get concerned, though, if they are elevating their retaliatory comments to the U.S. and they are successful at it. Will that make them feel more empowered, more emboldened to do something at a quicker timeline? So these tariff negotiations that we're coming up on between China and the U.S. for us will be very important tell for us to better understand that.
I mean, it's one of those things that it's hard to, if you don't get to the point where you feel you have to put it in the baseline forecast, then you can't really it's this perpetual risk that you're worrying about. But am I putting it as part of no, right? I would say probably, in a way, President Trump is more of a deterrent attitude to doing that because, you're going to respond. You're not just going to threaten respond. So, in a way, I would say, oddly enough, maybe it de-escalates the risk in that regard. But it's one of those things. And the other reality is, I worry about so many other things and so many other areas where, you do see China pushing against, U.S. dominance pretty much everywhere around the world where you're looking, whether it's in the Arctic or it's in the Panama or everywhere else. So it's not just Taiwan, right? It's this ongoing pressure from every corner you look. So that is, Taiwan is one manifestation, but it doesn't have to be all the way there to actually be concerned about what happens. And I think, all these headlines, there is something behind why we are talking about this in many different parts of the world. So, there is a reason why China is described as a strategic competitor. They are a competitor and they're a big one, and it's a strategic concern for the U.S. I don't think that goes away.
I know I'm the lowly moderator, but I'd like to add to this. I think that China saw Russia's invasion of Ukraine as a very good sign of how the world might retaliate to a Chinese invasion of Taiwan. China is a lot more dependent on the rest of the world trading with them. They are not like a breadbasket. They don't have a ton of energy resources. They are very dependent on other countries. And if essentially the NATO, alliance clamped down with sanctions like we did on Russia, I think you would see the Chinese economy suffer dramatically. And I think they know that. And right now, that would be what do they say? It would hurt them when it hurts to be hurt. So I think that's going into a lot of they're doing some saber rattling like everybody else is. But I agree. I think that the chance of that is fairly low. We are coming up on time. Do we have another question? One more?
Just one quick question. So if you look at like a NVIDIA chip or like the iPhone, like the trade statistics look terrible, but all the value is captured here in the U.S. So the trade looks awful on the NVIDIA chip because it's made there and then we import it. But all the value is captured and all the shareholders are here and you're getting a huge multiplier on earnings. Do you think the policymakers or the economist community talks enough about this that from a value perspective, it's amazing for America, but from the traditional way economists look at it, it looks awful?
So I think that's been one, economists tend to love productivity and efficiency, and economists would look at that way and say, it's actually great. This is, you're producing it in the cheapest place possible. It's wonderful. Well, life is more complicated than that, right? So it's great for the company margin, but maybe not great for the workers, right? So I think that's where over the last few years, this whole pushback against globalization, I think there's been a realization not everybody wins in the same way, right? And, yes, you like trade, but you also have to make sure that all parties to the trade follow the same rule, right? So yes, I would agree to some extent, but I think it's not just that. And I think now the whole world has moved to it's not just about efficiency. I mean, frankly, COVID taught you that, if nothing else, right? I mean, what use was it that you had the factory in China if it was closed and you had no leverage to say to them, open up, right? Or what good is it to you if now suddenly, your factory is up there and you have to go through the, your ships are getting attacked, you have to go around all of Asia. So it's become, reliability and control and dependability in the supply chain are rising in prominence, and it's not just about the cost, because it's the financial cost and there's the cost that you incur indirectly when actually you have no control over your supply chain. And I'm under no illusion that the deficit will disappear. You know what? The worst thing for the world would be for the U.S. tomorrow to close the trade deficit. That would be a recession for everybody else. Because, they all sell to the U.S. consumer. If that goes away, suddenly, $1.3 trillion overnight, that's a problem for the rest of the world. So, it's this kind of equilibrium that works, They buy our debt and we buy their goods, but, you also probably want to shrink it to some extent.
So, if there are no more questions, I would like to ask one more just to kind of change it up, and then I'll have some closing remarks. Is there one major market that you think that, either colleagues of yours, you disagree with them, or something that we think we're all missing, something that's kind of the diamond in the rough, if you will? And if you don't have one, that's completely fine. And then to add on to that, to sum up what we've talked about tonight, what is your key takeaway for for investors going into 2025? And where's the S&P going to be? Because I know we want a number.
This
We want a
is
number,
like
right?
bait
We need
and switch. It was one question, then it became two, and then three. I was like, what
Well,
is
there's
it?
three, there's A, B, and C.
It's question inflation.
So, some area, when you kind of just play out how President Trump might be thinking here, he needs to appear strong, be strong to negotiate with the other powers across the globe. His opening salvo was very focused on our neighbors to the north and south. So those asset repricings that we saw in both of those countries, I think offers an opportunity, because many individuals think like, okay, we're going to get a 30-day kind of kick the can situation, and then we'll kick the can further and further. And this is going to continue to allow those asset prices to have that embedded risk premium in it. What if they all combine together and they create kind of this larger block, a united front to, be a strong man on this side of the globe to better negotiate to the east? And I think that is not something that individuals are saying, that they can see Sheinbaum and the Canadians coming together with Trump at a table and actually coming to stable agreements that have teeth to them. And that would be a dramatic repricing you would see across Mexican assets. I think that would even flood through to Latin America in many other countries. And if Canada was able to get in on that, that would also probably have green shoots to the UK also. So I don't even think many are talking about that scenario playing out. Your second question was a summation of...
Yeah, it's sort of the last question
evening.
that probably everybody gets, which is, what's the key takeaway for tonight?
Sure. The key takeaway, what we talk about most is that diversification from a regional and industry perspective. That is always the case, but in today's world, it's ever more present. The ability and the willingness to be tactical in your portfolio allocations. Don't marry a trade. This market is going to change. It's going to change fast. And most of what President Trump has come out and said he is going to do, he is actually carrying out and doing it. So being able to follow his playbook as he's kind of flooding the field with new information every single day is going to help us earn more consistent returns. If we can almost take him at his word at the onset, let asset prices reprice, step back in again, realize some of that price appreciation, and then move on to his next idea. It really is peeling back the brain of President Trump and trying to trade throughout his thought process. The last question was on S&P. I'm going to just go with 6,600. I'm concerned about the U.S. exceptionalism carrying through.
Let's see. Okay, yeah.
So I promise you we did not coordinate on this question, but at first I was like, I actually don't quite know how to answer your first question, on like the market that's underappreciated. But I think, I was going to say Mexico is one of them. And the reason is, they are so much in the headlines right now. But the truth of the matter, just like with the immigration, the U.S., the whole reshoring initiative and nearshoring initiative simply cannot succeed without Mexico, right? Labor costs in the U.S. are too high to bring everything back here. You're going to bring the high value-added stuff, the strategic industries, but you do need to bring other things at least closer, right? So, like, maybe you don't like Mexico, but guess what? You like China a lot less, right? So it's all a matter of rankings. And frankly, I would love to see what the scenario you laid out where you're like, let's differentiate between allies and non-allies, and the whole of LATAM has something that did not matter for 20 years, which is proximity. It does depend, like country by country, how they play it. Look at El Salvador. You have very unconventional offers being put on the table, right? But, genuinely, you should try to say, like, how do we, the countries that, are truly U.S. allies, and Europe has leverage too, like they can come and not just sit there awaiting for the tariffs to be thrown at them, but proactively come out and say, okay, how we want to work with you, because frankly, there is no other natural, more natural alignment for Europe than the US. Who else are you going to pick? Please tell me, right? So like, why are you like beating around the bush, and why are you not like trying to like say, okay, we stand with you, how can we work together? And then you don't have to worry about tariffs, right? But you do need to like, get up and do things, partly to help yourself and partly to like support the alliance. I would love to see that. That would be like I would love to see that scenario play out. And frankly, I don't think that we need to like completely dismiss, scenarios that seem too logical in this illogical, period, because I think the goals are actually quite logical. And like a lot of the policy ideas, like maybe it sounds crazy how it's done and presented, but like there is a kernel of, reasoning behind it. So, I would, maybe that, that's the upside that we actually don't dare, hope for.
Triumph of the optimist.
Always. I mean, like to me, the glass is always half full. I was telling my colleague earlier. I'm like, I grew up under communism in Romania. We had 10 minutes of cartoons a day. On Saturday, when we had school, by the way, you would run home because you had 20 minutes on Tom and Jerry. If you missed it, that was it. You wait until next week. So like, I'm like, going from a world where like trying to go from Romania to Hungary, you might as well would have asked to go to the moon, to be here today, to, like the opportunities the world has, is, it's a wonderful life in many ways. So I'm grateful for that. So yeah, to me, the glass has to be half full.
That's a good way to cap it off. Yeah, please join me. It's so great they made the trip down. I hope everybody enjoyed this format, enjoyed the conversation. Thank you all for making it out. Thank you to our sponsors. And thank you to Ellen Borges once again. Without Ellen, we could not make any of this happen. It would be a complete flop. So thank you, Ellen, and thank you to all the folks at the Commonwealth Club. And we'll wrap it up.
Thank you. Thank you so much.